Hello and welcome to Impact Tuition. Another season of learning is here as we prepare towards the ICA Ghana August 2022 exams. This is financial reporting. We'll be discussing tangible non-current assets, the standards that cover tangible non-current assets within the scope of the financial reporting syllabus. IAS 16, IAS 40, IAS 20, and IAS 23. This is PPE, property, plant and equipment. This is investment property. Government grants and disclosure of government assistance. And then IAS 23, borrowing costs. We've already treated IAS 16 PPE, which is available on our YouTube channel. So we'll focus on these three: IAS 40, IAS 20, and IAS 23. We'll begin with IAS 40, investment property. IAS 40 applies to the accounting for property, land and/or building held to earn rentals or for capital appreciation or both. Now, a distinction has to be made between IAS 16 and IAS 40. When an entity owns property that it occupies, so owner-occupied property, then that becomes IAS 16. But in an instance where the property, which could be land or building or both, is owned by an entity, that property is accounted for using IAS 40 if the entity holds the property to earn rentals or for capital appreciation or both. So investment property is land or building, and the purpose is held to earn rentals for capital appreciation or both. We must note, owner-occupied property is excluded from the definition of investment property. Owner-occupied property is excluded from the definition of investment property. Now, there could be situations where a building can be accounted for in two different ways. If the entity occupies the premises but rents out certain portions to other businesses. In such an instance, the part that is occupied is classed as PPE and to be accounted for using IAS 16, and the portion that is rented out is classed as investment property, and that portion will be accounted for using IAS 40. So this is our note 1, our second note. In situations where a portion of a property is owner occupied, and the other portion is rented out. This portion of the property, which is owner occupied, is accounted for using IAS 16, and the portion that is rented out is accounted for per IAS 40. Investment property. Let's dig a little deeper. Let's consider consolidated accounts. Consolidated accounts are accounts prepared by a group, and it has the accounts of both the parent and subsidiaries put together into one account. That is consolidated accounts. Now, if a building is rented by a subsidiary of the entity, then the building will be classed as an investment property in the individual accounts. But in the consolidated accounts, it will be classed as PPE. And the reason is because the asset to be used by the group, so it must be accounted for in accordance with IAS 16. There's a building which is being shared by both the parent and the subsidiary. Now, in the individual accounts, it will be classed as investment property. But upon consolidation, it will be accounted for using IAS 16 because it is being used by the group, which is seen as one entity. All right. The parent and the subsidiary using portions of the building. Now, in the individual accounts, the parent will classify the building as an investment property. Now, upon consolidation, the building will be classified as property, plant, and equipment and accounted for per IAS 16. And the reason is because the asset is being used by the group. Which is made up of the parent plus the subsidiaries. Okay. What is the accounting treatment for IAS 40? Accounting treatment. Investment properties should be initially measured at cost. This is according to IAS 40. Investment property should initially be measured at cost. Subsequent measurement. IAS 40 gives two choices for subsequent measurement. So we have two choices. We could choose between the cost model or the fair value model. Once the model is chosen, it must be used for all investment properties. How does the cost model work? Under the cost model, the assets should be accounted for in line with the cost model laid out in IAS 16. So for the cost model, we apply the same cost model as we have it in IAS 16. The investment property will be carried at the cost less accumulated depreciation. And that will give us the net book value or the carrying amount in the balance sheet or the statement of financial position. Now let's focus on the fair value model. Under the fair value model, the asset is revalued to fair value at the end of each year. The gain or loss is shown directly in the statement of profit or loss. No depreciation is charged on the asset. So this is all for the fair value model. Now the fair value is normally established by reference to current prices on an active market for properties in the same location and condition. Now fair valuation is the subject of another standard which we will look at sometime later. Let's take an example to test our understanding. Let's look at this example. Majesty Enterprise, a manufacturing entity, purchases a property for 1 million Ghana cedis on 1st January 2021. The date first January 2021 for 1 million Ghana cedis. Now the land element of the cost is believed to be 400,000 Ghana cedis. And the building element is expected to have a useful life of 50 years. As of December 2021, local property indices suggest that the fair value of the property has risen to 1.1 million Ghana cedis. 31st December 2021, the fair value of the property is 1.1 million Ghana cedis. Now we are required to show the property, to show how the property would be presented in the financial statements as at 31st December 2021 if Majesty Enterprise adopts the cost model and the fair value model. So we are required to show the presentation of the property in the financial statements if Majesty Enterprise adopts the cost model and then B, the fair value model. Now our solution. Going by the cost model, the assets will be presented in the statement of financial position as at 31st December 2021 as the cost less accumulated depreciation. Land isn't depreciated, so our focus for depreciation will be on the building element, which is 600,000. The land element of the property is 400,000, so the remainder is our building element. So depreciation for the year will be 600,000 it's 1/50 because the useful life of the building is 50 years and we are at the end of the first year, so 1/50. And the answer is depreciation for the year, which is 12,000 Ghana cedis. Now, in the statement of profit or loss, profit or loss, the depreciation charge will be 12,000. Which will be recognized as an expense. And then the statement of financial position, the asset will be carried as at the cost less any accumulated depreciation. So in the statement of financial position, we would have the asset carried at 1 million Ghana cedis. Minus the depreciation charge of 12,000, and our net book value or the carrying amount will be 988,000 Ghana cedis. So this is it for the cost model. Using the cost model, the asset is carried at the cost less accumulated depreciation. Now, because we are given the useful life of the building element to be 600,000, we have to calculate our yearly depreciation. The asset has a useful life of 50 years and we are at the end of the first year. And that is why we have 1/50. So 600,000 times 1/50, or 600,000 divided by 50, which will still give you the same amount of depreciation, to be 12,000 Ghana cedis. This 12,000 will be recognized in the statement of financial position as the depreciation charge for the year. Now, in our statement of financial position, the asset will be carried at the cost, which is 1 million, less accumulated depreciation of 12,000, giving us a carrying amount of 988,000 Ghana cedis. This is for the cost model. We continue with the B part, the fair value model. Going by the fair value model, we would have a fair value gain of 100,000. The fair value of the asset at the end of the year is 1.1 million, 1,100,000. And then the fair value, the cost of the asset is 1 million. This is giving us 100,000 Ghana cedis as a fair value gain. So, in our statement of profit or loss, we would recognize 100,000 Ghana cedis as a fair value gain. In the statement of financial position, the property will be shown at its fair value. So in our statement of financial position, the carrying amount of the asset of the property is 1,100,000. There is no depreciation charge. Right. So this is all for the accounting treatment of the property using the cost model and the fair value model, respectively. And let's look at the final part of our discussion, that is movement between IAS 16 and IAS 40. But there are situations where an asset would be owner occupied for some time and then it will be transferred to investment property. In such an instance, what do we do? So transfer from PPE to investment property. The first thing is to revalue the asset per IAS 16. Now when the asset is revalued, it will create a revaluation surplus in equity and then to be transferred into investment property at fair value. It is quite easy. You revalue the asset per IAS 16 and the fair value of that asset will be the cost at which the asset will be transferred into investment property. So first, revalue the asset per IAS 16 and then transfer into investment property at the fair value. Now, if the cost model is used for investment properties, the asset is transferred into investment property at the current carrying amount and continues to be depreciated. Let me underline this. Now, if the entity adopts the cost model for its investment property and you are transferring an item from IAS 16 PPE to investment property, you transfer the asset into investment property at the current carrying amount and it continues to be depreciated. If an asset is transferred from investment property to PPE and the fair value model for investment property is used, what do we do? Now, this is the transfer from PPE to investment property. You revalue the asset per the rules of IAS 16 and then you transfer the asset to investment property at the fair value. If you adopt the cost model for investment property, there is no need to revalue. You transfer the assets from PPE to investment property at the current carrying amount and then it continues to be depreciated just as you do under IAS 16. Let's look at the other side of the coin. Transferring from investment property to PPE. Now, where the fair value model is used for investment property, what do we do? Revalue the asset per IAS 40. We revalue per IAS 40 and recognize the gain or loss on the revaluation to profit or loss. and then transfer to PPE at the fair value. Right, now you are transferring from investment property to PPE. Where the investment property is fair valued, before you transfer to PPE, revalue the asset first using the revaluation rule, the fair value rules as specified in IAS 40, and then you recognize every gain, any gain or loss in profit or loss. Then you transfer the asset or the item to PPE at the fair value, where the cost model is used. The asset is transferred into PPE at the current carrying amount and continues to be depreciated. So if the asset is, if the investment property is carried using the cost model, you transfer to PPE at the current carrying amount. And then continue to be depreciated. So these are the rules for transfers between PPE to investment property and vice versa. Let's end our discussion with some disclosure requirements. Now, apart from the figures that will be presented in the statement of financial position and the statement of profit or loss, what other information must we provide about property plant? Must you provide about our investment properties? Disclosure. You must disclose whether the fair value is used, you must also disclose the amounts recognized in the profit or loss. You must also provide a distinction between the portion which is owner occupied and the portion not owner occupied. You must also disclose restrictions on the realizability of investment property. Must also disclose depreciation method used, the useful life, accumulated depreciation, and the gross carrying amount. Now the list is not exhaustive. You can visit the standard to read more on the disclosure requirements. And that brings us to the end of our discussion on IAS 40. Kindly like this video, subscribe to the channel, and share with friends who would need these tutorials. Thanks for watching. See you in our next video.